See, gross investment is the total production of capital goods during a year, how much of a capital goods was produced, okay? And that equals to net investment plus depreciation. What is net investment? It's the new capital goods, okay? Means the net addition to the already existing capital goods. It's the addition, okay? And whereas depreciation is the replacement to already existing capital goods. So depreciation is also known as replacement investment because it's a replacement for the already existing ones. What is the significance of net investment? See, net investment increases the stock of capital. So obviously it increases the availability of labor per capital per unit of labor, okay? For 1 unit of labor, now we are going to have more capital, and so the efficiency of labor is going to increase. There's going to be more employment opportunity, there's going to be more production capacity of the economy, and this GDP is going to increase, okay? Now, what is the significance of depreciation? What is depreciation first? Let's see. Depreciation is also known as consumption of fixed capital. Okay. And now, what is consumption of fixed capital? The fixed capital, if we'll use it for so many years, its value is not going to remain the same. It's going to, deteriorate day by day. So, fixed assets, they go down in value because of three reasons. First one being normal wear and tear of goods. Second one being accidental damage. And third one being expected obsolescence. What is expected obsolescence? That's obsolescence due to, that means it becomes outdated due to change in technology or change in demand, okay? So because of these three reasons, depreciation takes place. And for coping up with depreciation, firms create depreciation reserve fund, okay? They are the funds that they use for replacement investment, okay? And see, if they do not create depreciation replacement fund, then there's going to be lack of replacement investment, because of which overall investment is going to be down if there's going to be no replacement of the existing capital stock. Because of overall investment going down, there's going to be fall in output. Because of fall in output, there's going to be less income and less employment. Because of less employment, there's going to be economic slowdown, okay? And it's going to impact the entire economy as a whole if there's going to be less depreciation reserve fund. Now, there's not only expected obsolescence, there's also another thing called unexpected obsolescence, okay? For example, we have expected things like change in technology and change in demand, but we did not expect things like earthquake, flood. So that is known as natural calamity and fall in the market value of asset due to economic recession. These are both the examples of unexpected obsolescence, and they are known as capital loss, okay? Other one was known as depreciation, expected one, and these are capital loss, okay? And they are not managed through depreciation reserve fund, they are managed through insurance of the asset. Next, we are going to study about what is stock. What is stock? Is the quantity that's measured at a particular point of time. For example, now I say if I have 1 lakh in my bank account, so that's the stock of money I have, okay? And it's not time dimensional. It's not about a period of time. Whereas flow is a quantity measured over a specific period of time. For example, if I say I get rupees 2,000 per month, or I pay rupees 1,000 per month, so that is a flow. It is time dimensional. It is according to per hour, per month, or per year, okay? And see, this mutual dependency between stock and flow. If there's going to be more stock, there's going to be more flow. For example, if I deposit rupees 2,000 in my bank account every month, then at the end of the month, I'm going to have a good amount of good amount in my bank account at one particular day. That's going to be my stock. And when I'm depositing all these every month, that is my flow. So because there's a continuous good flow, that is why there will be a good stock, okay? Let's see the four sectors in an economy. Let us look what are. First one, household sector. What is household sector? We are all household sector. They're the consumers of goods and services. They're the owners of the factors of production. What are factors of production? Factors of production are land, labor, capital, and entrepreneur, okay? So like they provide the land, they are the laborers, they provide the capital, and they give the entrepreneur services. So this is household sector. Next one being producer sector, okay? Producer sector, all the producing units of the economy who produce goods to satisfy the wants of the household sector. The next is government. We all know what's a government. It's the welfare agency of our economy. Next is external sector. External sector means rest of the world sector, that includes all the other countries, all the exports, all the imports made by a country, okay? Now let us look at intersectoral flow. What is intersectoral flow? It's every sector of economy. It's dependent on each other somehow or the other. For example, household and producer. Okay, the household is dependent upon the producer for the supply of goods and services, and producer is dependent upon the household for the supply of factors of production. Okay, Now, see, producers and households are dependent upon the government for administrative services, whereas government is dependent upon producers and households for its tax and non-tax revenue. So here we see the interdependence between all the sectors of economy. They cannot stay independently; they have to stay in connection with one another. Okay, so see here, there are two kinds of intersectoral flow. First one being real flow and next one being money flow. Let us look at what is real flow. Real flow is the flow of goods and services. Okay, this is household sector. Let me tell this is household sector, and this is my producer sector. Okay, just a second, I'm so sorry. Now see, in real flow, it's the flow of goods and services. So the household sector is going to provide the producer sector's factor services. Factor services like they are going to provide land, labor, capital and entrepreneur. In return for which the producer sector is going to provide the household sector goods and services. Producer sector is going to provide, produce and give them goods and services. So this is the real flow. It does not include any transfer of money. Next is money flow. It's the flow of money. So see, for here, the household sector gave the producer sector the factor services. So in return for which the producer sector is going to give the household sector factor payment, which means for land they're going to give them rent, for labor they're going to give them wages or salaries, for capital they're going to give them interest, and for entrepreneur they're going to give them profit. Okay, so these are the four things on basis on which they're going to make factor payment. So the household sector, it gave them factor services, and then the producer sector gave the household sector factor payment. Now here the producer sector gave the household sector goods and services, in return for which the household sector will pay the household sector will pay the producer sector. That means they will do the expenditure on purchase of those goods and services. Right. So here money flow is just a reciprocal of real flow, because real flow happens, that's when return for which money flow happens. Okay. I hope you understood what's real flow and money flow. This is the household sector, this is the producer sector. Household sector gives the producer sector factor services, in return for which the producer sector gives the factor payment. Then the household sector buys goods and services from the producer sector, in return for which they give the producer sector money. Okay, payment for all these things.